You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is financial consultant and wealth manager Richard Knowles of Knowles & Associates in Vancouver. Welcome to the show, Richard.
Hello, Jim. Thank you.
Some interesting numbers for us to take a look at. You said some very interesting action on the American stock markets, but the Canadian stock market reacting differently to financial changes, mostly due to the oil patch. First of all, what's happening in the U.S.?
Well, if you're looking at values today, of course, with markets, you can be talking about bond markets, you can be talking about stock markets. Typically, when people are talking in the news, you hear about stock markets because that's the exciting news of the economy growth. However, there is some positive news on the bond markets, and somewhat negative news in some ways on the stock markets. In the stock market area, there's great growth. We've seen a lot of great growth. We're coming off some very high, big highs in the markets. And one would think this is a great time to be in the stock market. Well, it has been a very good time to be in the market. However, to be entering the market, to be buying things now in these high valuation times in stocks is very, very dangerous area to be in at this time because the company's valuations are so high that you don't know where good value is. It's very difficult to go shopping now in the stock market in the U.S. simply because valuations aren't as good a deal as they were in the last 5-6 years. So we're at sort of an end of a cycle. Now, it's a very important thing for any investor to know is that we're at the end of a cycle and going to be beginning a new cycle. However, it's usually a very painful end. We typically enter into what's known as a recessionary year or a pullback year in stocks. This is anticipated to be one of those. At some point during this year, we're going to see some lots of volatility. We definitely, throughout the year, we're going to see tons of volatility, pullbacks in the markets, opportunities to buy, of course, when these pullbacks happen. But there is a bit of a treasure trove of cash building up on the sidelines in anticipation of that, simply because the deals aren't out there as clear-cut as they used to be. Compound that with the fact that the economic news that's coming out just even today from the federal minutes that are going to be posted in about 2 o'clock Eastern Standard Time today. We're going to have it's pretty much anticipated that everything's going to be status quo, no interest rate increases until June at least to be reviewed. They were planning to look at it again, having interest rate increasing actually as early as this month or next month, I should say, or possibly March. But they're really not going to be doing that simply because they're realizing that the drop in oil and all the other factors that are going into our economy right now is just not supporting an increasing interest rate. It's not supporting a threat of inflation. So while the stock market's doing great, the economy is still struggling to catch up to what looks good on paper. So what we believe is going to likely be happening and has been happening is that while stocks are still achieving high points, and certainly individual names could be good, the overall stock market is struggling to hold at these levels. It's moving laterally or sideways at this time. The Canadian stock market's correct downwards for the most part simply because of oil. We're such an oil-based nation that when oil dropped in its price per barrel, while on the face of it that doesn't look good for oil companies, obviously, because their earnings are going to drop, it doesn't mean they're going to stop. So it just means they're going to drop. So stocks are correcting down to valuations that are going to be anticipated to be their real value looking forward at these price points of oil. But they're still making money. We're just going to be having less earnings. Consequently, what will likely happen this year, we'll see oil companies probably doing share buybacks, which will reduce their liquidity of shares on the markets, which will increase the value of the shares themselves, as long as they have some money to do that with. In addition, we have the ability for the overall picture for the consumers of North America and certainly around the globe will be more spending money in their pockets. So other areas of our economy, other than resources, will start to take off simply because people will have extra spending money with this low inflationary environment and continuing low inflationary environment. They have more money in their pockets to spend, and that will help consumer products and other areas of our economy look quite bright. So that should actually spell very good stability for the year for our economies and actually give the consumer a fair break, finally, simply because energy costs are coming down. With energy costs coming down, of course, manufacturing costs will come down, and that savings in product pricing should also pass through to the consumer, in theory. We hope that happens. We never know what the, products will be sold for. But I think people will, companies will learn to understand that the dynamic of their consumer, they're buying their product, if probably would facilitate their own benefit as a company to pass some of these savings on to the consumer in lower prices and consequently bring in more business. Finally, we look at the bond markets. The Canadian bond markets certainly are very important to us in Canada, but the global bond markets in general, with lower interest rate environments, even dropping interest rate environments, that actually boosts bond values simply because that's the way the relationship is. I could go into whys, but I think most people understand that when you have dropping interest rates, the bonds that have fixed rates higher than the dropping interest rate are worth more today while the general rate is dropping. Now, if that takes a reverse, in other words, when interest rates start to increase again, we don't know when, but let's say it's further on in the year, that could spell negative news for the bond markets. But right now, people in fixed income bonds are actually quite happy because they're getting excellent returns. We're coming off an average last year of about 10% return in bonds and fixed income of that nature, particularly bonds. And we're going into a new year where the valuations are still making headway. However, we have to be very cautious if you're in bonds, simply because you have to watch into the future to see when interest rates could start to take a turn and inflation start to increase again. With inflation, of course, means that we'll have a growing economy. So while we're anticipating this to be part of that cyclical pattern, we see approximately over 6 to 7 years in North America, we see a cycle where we get a recessionary year after a good 6 years of growth we've seen. It's 2008. This is the year we're expecting it to have. If anything, it's just a slow grow year or maybe even a negative growth year with a recession. We expect, of course, on the flip side of that, in 2016 and beyond, a new cycle of 6 to 7 year growth period will start to happen again. And we can buy into that by positioning throughout the year, carefully positioning throughout the year. At low points, that's when new money should be coming into the system if you're planning to buy in the stock markets. And if you're planning to buy in the fixed income bond markets, you just have to be careful that when the turnaround starts to happen in the late 2015 into 2016, you have to be getting out of bonds. You have to be very careful not to be caught in that upswing of interest rates. If indeed it starts to swing up too quickly, you want to move out of bonds, even if it's just to cash or to some other income options that you can speak with your advisor with.
You're mentioning that this perhaps could be a good year for mutual funds.
Yeah, this is what we call the managed portfolio year. People with managed portfolios will outperform typically your own individual portfolios. Yeah, there's a big joke in the industry. You can put up a dartboard when there's a bull market up. You just put up a dartboard of the stocks on your newspaper page and throw a dart at it, and then you can usually make money. So it's easy to make money in a bull market simply because everybody tends to ride upwards. Now, I don't want to oversimplify it, but there was a portfolio created of someone that just actually threw darts at a dartboard and just invested according to that. They wanted to see how it performed, and it actually performed on an average basis, which doesn't surprise me typically, when you're taking an average. However, the reality is in a negative market, in recessionary years where you have to be very good at stock picking and you have to know your research and you really have to know your analysis, those are the test years. Now, if you look at test years in the past, you'll typically see terrible performance for individuals that do not typically know or have access or have knowledge of good research in their buying, and they don't have a programmed planning. In other words, something where you're allocating a stock to 5%. Let's say you want to buy 5% in pharmaceuticals and you bought 1 or 2 stocks to fill in your portfolio 5%. You don't have that rigid discipline that when it grows to 10% of your portfolio, you should sell off back down to 5% and take the rest as cash and do something else with it. When you have these disciplinary measures that have been built over long, decades of knowledge of portfolio management, lots of individual day traders don't follow any of that. They just follow the wind, whichever is making money that day, and then trying in and out and in and out and in and out, stay in cash when they can. And then there's the variations between those themes. Well, in these kinds of markets that we'll see this year, lots of volatilities, there's great opportunity for day traders. However, there's enhanced risk, more trading, more costs, and of course you get caught in downswings. People can lose on shorts that they put, stop losses, for example. You have to really understand in these markets there's certain equities that could go up and down in crazy versions where you're going to have big pullbacks, but that will be normal in this kind of market. So you don't want to have your stop loss triggering at a point where it literally cuts you off as a stock and then just to buy back in again later. So you really have to understand the nature of these instruments prior to using them. And in these kinds of years, the people that really know what they're doing are the institutional players. So you have these mutual fund managers that really will shine this year. The top managers of the last few years kind of just haze into the numbers, but this year they tend to shine because their expertise and their knowledge will outperform the average portfolio out there, and it sets a new benchmark for the fund industry. So you'll see this year be a very good year for the fund industry as a whole because people will be so confused as to what to do with their portfolio. It'll be stagnant. There'll be things they'll be losing when they're hearing that some portfolio being managed by mutual fund managers making gains, and they'll wonder why they're not. Individual retail brokers, the stock jockeys that are working at some of the banks, etc., they think they can outperform a big mutual fund institutional research department. Well, they can try. In some cases they can. In bull markets, everybody can look good. But it's in the negative recessionary markets where the real pros can shine. And this, I believe, will be a good year for mutual funds and mutual fund managers in general, segregated fund managers and insurance companies as well.
We'll have more with Richard Knowles right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Richard Knowles of Knowles & Associates in Vancouver. The big banks have cut their prime rates 0.15%, not matching the central bank's rate cut of 0.25%. However, some headlines are already predicting that we might see record low mortgages because of this reduction.
Yes, I agree. I don't doubt that at all. I think it will also help to spur the economy. It will help people structure their debt far more efficiently and free up cash flow as well by transferring from high debt instruments like Visa cards, etc., to low debt, debts, structuring at a bank with a line of credit, for example. There'll be renegotiated mortgages. People that are using fixed rate mortgages may even be able to renegotiate at better rates, even with a penalty. So that's a good trick offered by mortgage brokers. You should talk to one if you haven't. Way to get out of a higher rate mortgage, pay your penalty, and still bonus out within a very short period of time at these lower rates. Also, there's advantages that we see with borrowing to invest. If you've been investing for a while, but you have lots of equity in your home, you're comfortable with the equity in your home, but you'd like to invest as well. It's great maneuvers. One book written on it called The Smith Maneuver, but I'll give some credits to these people that wrote books on it. But the reality is we've been using this for decades in the industry. It's the idea that you can borrow from equity that you own to invest, and the investment will grow faster, of course, than the loan rate, and plus the interest rate for investing, if it's done properly, is tax deductible as well. So you have this way of creating your own mini corporation, whether to buy a real estate, for example, rental property, or you could buy an income investment, which could be an income mutual fund, very commonly used, good ones. They create income to pay the debt, and then you have surplus as well to either keep as investment to grow, or you could use as cash flow in your life and business. So these tricks of the trade are very opportunistic at this time, with low interest rates and continuing lower interest rates. But I think more importantly for most people to realize is that this is a signal, and the signal is coming from the economists and the chief economists of the country, stating that they believe that we need to help our economy by lowering costs of borrowing, both for businesses and individuals, simply because the economic recession we're heading into, it's a statement that we are heading into a recession, not by action, by action rather than by statement. So in other words, I hear what you say, but I see what you do. And what they're doing is they're telling us that the actions that they're making are telling us that we anticipate this year will be a recessionary year. So prepare yourself for a pullback. I think most people, certainly in the oil sector, already know it's going to be a recessionary year for them. There's people being laid off. It's much like the mining industry. There's lots of unemployed people in big mining cities like Vancouver, for example, that were in the mining sector, waiting for it to recover. It is a very cyclical sector, and when it does well is in inflationary. When we turn into an inflationary cycle, which we haven't seen in many years, we're going to be seeing, and that's when mining comes back. So that's part of that cycle. So when we see inflation start to increase, which could be actually next year, 2016, in my opinion, we'll start to see the mining sector recover along with inflation. So, at this point, the question is this going to help the real estate market, for example? Dropping mortgage rates often spur people to buy in real estate, so that will prop up and keep these high values in certain cities anyway, like Toronto and Vancouver at these higher levels. Is this a good time to buy, or is this a good time to stay on the sidelines and wait? We don't know. So it adds a little bit more question mark over the real estate markets in the two biggest cities of real estate pricing right now and housing and concern of high prices, which is Toronto and Vancouver.
Richard, you also mentioned that precious metal coins can be a good deal this time of year and also perhaps a hedge against a falling currency, which our loonie is.
That's true. What we have, there's this particular type of product. I'm sure the Mint will be very happy for me to promote this product for them, although I'm not paid to do so. There are products, for example, the ones that I've been very interested in are the ones that aren't collector coins. Now, you see many collector coins issued by the Mint. You can buy a 1-ounce coin, for example, of silver, and typically the silver coin will be priced at the ounce of silver at that time. So let's say currently it's 17 and change. Let's say it's $17 today. Then the price of an ounce of silver would cost you $17 based on weight of silver. However, because it's a collector coin, they might mint it. Only 80,000 might be minted, and therefore it has collectability, and they'll probably sell it to you for $23 or $24. What's interesting about those particular coins, and I'm not using any particular coin as an example, I'm just using it as a generic example. You'll have a coin which will have an ounce of silver in it, and it'll be sold to you for $23 because of its collectability, in addition to the weight of the silver. But if you look at the face value of the coin, it could say anything. It could be $5 worth of a coin. In other words, if you were to take that coin that you just paid $23 for as a collector, really, and you go down to the store to spend it, the store owner need not give you $23 or whatever its collectability value is. They only have to pay you, according to the law of the land, the value of the coin, which in this case would be, say, $5. So those coins are really only collector coins. You don't want to be caught with those actually spending them, because there's not much value in actually spending them and using them that way. They just sort of put a token value on them. However, they came up with a new idea. It's pretty much exclusive to Canada that I've seen. They call them 25 for 25 coins, or 50 for 50 coins, or 100 for 100 coins. In other words, the coin's face value is the value of whatever I just stated. So, for example, we use $25 coin. It actually says $25 right on it. So if you had to go spend it, you get the value you pay for it. It's just like buying a $25 coin from someone that's worth $25, and that's all you pay. So for a $25 coin that says 25 on it, that's what you're paying. That's pretty neat. That's not news if you know currency. However, what's the underlying security of this coin is that it's also made out of solid silver. It won't be a whole ounce, however. You might find that it's only 0.3 of an ounce or 0.7, 7/10 of an ounce, etc. So what you're going to get is a solid silver coin, but the actual silver value, if you were to weigh it and sell it as a piece of silver, literally, might be only worth $7. So in that case, what you have is a coin being issued by the government of Canada that's worth $25, but it has an underlying secure value of the weight of the silver in an emergency where your currency might collapse. Like when we look at the Russian ruble back in 1998, heck, we feel that way every day when we're watching our own Canadian dollar drifting down to 80 cents. What if it drops to 50 cents again, the way it did, back in the heydays of the 90s for a while? In that case, you have a coin that has a stated value of whatever it says, available anywhere in Canada, but it also has an underlying value based on the metal, the pure metal it's made out of. So if the worst case scenario happened and we had a dollar which, let's say currencies really crashed around the globe, for whatever reason, say U.S. and Canadian currencies started to really get devalued over time, these silver coins would start to likely go up in value simply because they're made out of silver more than their face value is worth. In theory, silver could go in those kinds of scenarios where currency is going haywire around the world. The silver could go up in price to $30, $40, $50 per ounce. Well, in that case, your 7/10 of an ounce, or approximately 7/10 of an ounce, or 70% silver, or whatever it is, has gone up in price as well, and could even go above the $25 face value that it's stating. So in a way, what we can do with these particular unique coins from Canada, you can get them at no cost to you. In fact, if you go to the Mint now and you try and find if there's any available, they only issue them at certain times of the year, you can get them sent to you for free from the Mint. There is no cost for postage. So they send it to you for free. You pay exactly what, and there's no tax on it. So you pay $25 for a $25 coin, which is fine. Everybody can understand that one. And you can always get $25 value at the store if you had to do that. But then it's made out of silver, which gives you protection of the metal itself. I think they're brilliant coins. I think we should do a lot more of this kind of coin mintage in Canada. And I think that it's a great idea. I think it's supported by anyone that understands true foreign currency issues with paper money and wants more metal backing type of coins and certainly metal backing type of currencies to protect our own paper currency from devaluation. Really value these kinds of investments. I recommend it to all my clients.
Richard, that sounds like golden advice for silver.
And you can do it with gold too.
Thanks a lot for chatting with us, Richard.
Thank you very much, Jim.
My guest has been financial consultant and wealth manager Richard Knowles of Knowles & Associates in Vancouver. If you have any questions for Richard, you can send them to Richard K, that's the letter K, at customplanfinancial.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. We're also available on our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.